Howdy there, folks. Welcome into the buy one, get two free here today on the reaction channel. I got 3 videos to react to. Okay, first one up here, we're going to listen to the bulls and bears debate it out. Want to make some points and react to that one from 2 hours ago here, okay? Then I want to react to this one from this morning. This is actually very important video, actually probably the most important one we're going to watch and react to in this one here today, about what this individual's seeing out there from the investor market right now, the sentiment, where she's seeing certain types of sentiment. Very important. So that's probably the most important video out of these 3 we'll react to. And in this one, looking forward to getting into this one, Paul Tudor Jones makes some very strong, confident predictions about where stocks in the stock market are going for the rest of this year. And I would say he's very much a contrarian versus kind of what you hear as consensus out there right now, billionaire hedge fund manager. So yeah, looking forward to hearing his points and perspectives and kind of sharing what I believe off of what he says there. So appreciate everybody joining me. As always, a massive day here today. Reason being is we launched officially the 5-figure club in the Patreon Discord tier here today. If you'd like to join us in there, get in the 5-figure Hall of Fame, then check out the pinned comment down there. That'll be to join us in there. It's pretty epic. If you ever want to access my 6-figure workshop, by the way, send me a DM on Instagram. That's for people that make over $100,000 a year. I recorded a video last week. It's a private video that goes into kind of investing in 2023 and beyond if you have a 6-figure income plus. Okay, just send me a DM on Instagram that you're interested in that if you would like access. So yeah, let's get into this. Oh, and also thank you everybody. Subscribe to the channel. I appreciate y'all as always. I don't even know how many subscribers. It's a lot of subscribers, but thanks for being here, folks.
Here, let's hear 2 competing market calls. With me now, Sebastian Page of T. Rowe Price, Brian Belsky of BMO Capital Markets. Gentlemen, it's good to have you both with us. Sebastian, it's nice to see you in person. I'll turn to you first. You've described yourself the last 2 times you've been with me as a reluctant bear. Are you still?
I'm still reluctant. You know, I was just watching your prior guests, and it sounds like you need a bear on the show right now, so I'm happy to play one.
I don't know. Bears seem to be everywhere.
They are everywhere, and the reason is that the bearish narrative is incredibly compelling. Gabriella talked about the yield curve being inverted. The 3s to 10 is more inverted than it's been in all the data I have going back to the 80s. LEIs are flashing red. PMIs are down 17 points on the manufacturing side. Stocks are more expensive than they were before the 2022 sell-off, if you adjust for the level of rates, and on and on. The market, you know, we're expecting double-digit earnings growth in 2024. So it's a pretty compelling narrative.
What does a yield curve thing never faze me? Like why don't, at least in this situation, the reason being, you know, why I don't put any weight into that is we just went through a historic moment, right, where rates were at 0 and we raised interest rates in the fastest rate possible we've ever seen in history in terms of percentage, right? That's not likely going to stay around long term, right? And I think we all realize that. And so this whole inversion, not nearly as concerning for me as maybe other market participants out there. But yeah, so that's why I never really put weight in it as far as that goes. In certain markets you can, but in a freakish rate environment like we've been through, it's a non-factor.
With markets being up so much year to date.
My other guest is I mean, you're a bull, right? I mean, I don't even think you're that reluctant, are you, Brian?
Well, first of all, it's wonderful to be on with Sebastian, a longtime client. We've been in a lot of meetings at T. Rowe when I go down to Baltimore, so nice to see you, Sebastian.
Is that a flex? Is that a flex? No, seriously, like he's a client? It almost sounds like a flex to me, man.
No, I'm not reluctant, you know, from very big picture to intermediate to near term. From a big picture standpoint, remember, we still think that U.S. stocks are in a big 25-year secular bull market where the new cyclical bull started in October. We believe those lows are well in place. From an intermediate term basis, our target for the S&P 500 year end is 4,300. So it's not exciting, Scott, which brings me to kind of near term. The market's had a nice run here. We're trying to explain the unexplainable, I think, both on the bear side and the bull side. The traditional academic stuff isn't working for the bears, and the traditional academic stuff is actually against the bulls, but the market remains, quote-unquote, resilient. Add all of that up, and I think the market can, will, and should likely be soft heading into summer. But this is about stock picking, and I believe that the era of stock picking, like the 80s and 90s, is upon us. And I think that's what portfolio managers from the equity perspective are going to have to live with. Now, from an asset...
I agree with that, and it gets into the point of... Stanley Druckenmiller was making this point recently, and he was even warning about, many years of, a market that doesn't really go much of anywhere, right? And I'm certainly not going to predict that, but just imagine that scenario happens. That is an age of stock pickers, because I can tell you in that market environment, there's still going to be incredible opportunities. Look at this year. Look at the Dow. What's the Dow done this year? Nothing. It's giving you nothing for a return. Meanwhile, we have stocks that are up 20%, 40%, 60%, 80%, 100% this year, right? And so it just goes to show you this is a stock picker's market, folks, and I think we're getting back there. And on top of that, I think I'm going to go inside because that sun is beating down on me. Oh, my gosh. Alrighty, folks, we had to move this party inside. It was too steamy out there, man. Too dang steamy. It's that funny time of year when it's like almost summer, but not quite there, and it's like nice 1 minute, and then all of a sudden the sun comes out, and you're like, ah.
Allocation perspective, this is in Sebastian's wheelhouse, being a multi-asset person at T. Rowe. And I think he's going to do quite well owning both stocks and bonds. But the more kind of fundamental in his pickings, I think that's going to work. And I think for the first time in 10 years, you're going to want to own a little bonds.
You say that the bear case is so compelling, but is it getting a little tired? And is it getting a little played out? And when someone like Paul Tudor Jones comes on, who's been, I think, more bearish than not over the stretch, over the last year, let's call it minimum, if he's starting to see a little bit of sunshine through the clouds, why isn't it time to do that? He made some compelling arguments this morning on Squawk.
No, the trend is not our friend, and it's not turning. I think the way I would put it is, think of what I would call the four horsemen of the recession. The yield curve, which basically indicates the Fed is tightening and the long end expectations for growth are coming down.
Never a guarantee, though, for recession, right?
Not at all, but that's one of the four horsemen. I'm trying to summarize why the macro dashboard is flashing red everywhere. Second, the PMIs. I mentioned they dropped, especially on the manufacturing side. Third, credit conditions. Now, that one is peaking on the horizon, right? The senior loan officers, 46% of them, according to the last survey, are tightening conditions. When did we breach 46% in history, Scott? 2020, 2008, 2001, 1990, 4 recessions. And fifth, the last horseman that we're still waiting for, it's sort of starting. You saw on Friday claims pick up. It's unemployment, which is typically lagging. So when you put it all together, the only reason why, Scott, I'm reluctant, and to Brian's point, it pays to be invested in stocks over time, and we're just pulling back a little bit, is that a lot of these indicators flashing red, right? Your dashboard is red all over the place if you look at macro data. A lot of them are year-over-year data that represent the unwinding of massive COVID distortions. We pushed a bunch of cash into the economy, and now we're pulling it back. So we need to interpret those red signals carefully. And now I know I got to be the bear, so I'm going to stay the bear.
Well, you said you're reluctant.
There's certainly we have factors at play that are negative in terms of the macroeconomic environment, but it could also point you to a lot of things that are going very well, right? One such example that just hits my mind is, how has Apple earnings held up so dang well? Like, that's been the most shocking thing to me. And I think that speaks to, honestly, probably the strength of Apple, but also the strength of the consumer. Think about Apple. They had the absolute best thing, honestly, happen to them, right? The stimulus money, everybody forced to be home, what that did for computer sales and iPad sales and cell phones and all this stuff, right? And yet Apple's been able to come off of that high and actually remain in a decent spot in terms of their numbers. And it's been shocking, right? I mean, you would think like, oh man, their revenue has to be down 10, 20, 30%, something. And they've been extremely stable. You look at many of the other strongest companies, like a Microsoft, for instance, right? And they've been extremely impressive. You look at Meta, and it looks like they're at trough earnings, and they're going to get much better in Amazon, right? 2 other big dogs out there. And you even look at somebody like a Tesla, very tough environment right now for obviously auto loans, the auto sector in general, anything high-ticket purchases. That's Tesla. And you even see Tesla, I mean, their revenue was, 24% growth year over year? That's dang respectable, man. And so that's where you get many of these other factors where you're looking and you're like, things are holding up well. Obviously, unemployment's held tremendously well. So you have all these other factors you can look at that, man, it actually looks like we've held decent. Real wages went down for like ever, and now real wages look like they're going to start actually growing again, which is phenomenal. Like, that's the best situation. You want to see real wages outpacing, obviously inflation. So that's a great thing. So, it's a confusing time, and I understand, and that's why a lot of times it doesn't even pay to try to make any sort of investment decisions based upon the macroeconomic environment, because even in a time period like right now, you get so many mixed signals. I can show you something bad, I can show you something good, I can show you something bad, I can show you something good. Next video up here, this one I'm actually looking the most forward to, although this last one's the most interesting, but this one's good information.
Said everything that she's thinking, but let's talk to her. Says the market's been like a duck, appearing calm on the surface, but furiously paddling beneath. Let's bring in Amy Wu Silverman, head of derivative strategy at RBC Capital Markets. When I read it...
What an analogy. What an analogy. Are you kidding me? Oh, man, that's good. That duck analogy. Oh, I might use that for life. That's so good.
Actually, Amy, I thought you meant, hey, market's almost at 4,200 on the S&P. It's NASDAQ's up 20%. If it looks like a duck, walks like a duck, and quacks like a duck, it's a duck. It's a new bull market. But that's not what you meant. You meant that, as I just said, you can't tell what's really going on underneath.
Yeah, I mean, who knows? I guess it could be like a duck in that way. We'll see certainly how the debt ceiling resolves itself. What I meant was just it's appeared very calm, both from an equity perspective, Joe, but also from a volatility perspective. And the reality is there's been these violent sector rotations underneath. So, your headline VIX numbers are pretty muted, but if you look at the demand for VIX going higher, that's actually at historic highs. So there is concern. It's kind of forward looking.
And because we always talk about consensus and we use that as a contrary indicator, I was fascinated by what you're talking about with the VIX. Okay, so we wouldn't know from looking at it about all the call volume, which is expecting maybe a spike in the VIX. I guess you'd have to say it's similar to what we've seen in bills. It has to do with the debt ceiling, doesn't it?
That's exactly right. So, one of the charts that I've been looking at right now is if you just plot the VIX right now, year to date, against where we were in 2011, which was obviously a contentious debt ceiling, the VIX was muddling around in and about now as well, but you start to hit those summer months, you start to hit those 11th hour discussions, and VIX actually spiked up to 48. And then it spent the whole summer in and around 30. So, more than 10 full points above where we are now. And it still ended higher than 20. And I think the reason you're seeing this historically high demand for calls, essentially for VIX going higher from here, is because we're wondering if we're getting the 2011 playbook. And obviously, the higher VIX goes, the more the market is drawing down.
Right. So something I think a point she should have made there, in my opinion, is you might think, okay, people are playing VIX, Wall Streeters are playing VIX calls because they think obviously the VIX is going to spike, market's going to tank, things like that, right? So they must be bearish on the market. Here's another perspective, right? And there's certainly individuals that are doing that, right? But here's another perspective. What about the individuals that are long the market, right, and are looking for a hedge? There's many ways you can hedge in the market. I did a 45-minute video on a bunch of different strategies on hedging in the private group recently, okay? There's a million strategies out there. One strategy that you could utilize if you want to hedge your portfolio and you're long is buying something like calls on VIX, right? So let's, if you're scared about your portfolio going down substantially, instead of selling all your stocks, you could put a small portion of capital into VIX calls that expire in a few months from now or something like that. So then if the VIX goes crazy and the market drops substantially, we see a 15, 20, 25% sellout of the S&P 500, I can tell you your VIX calls are probably going to print a whole lot of money in that sort of scenario, right? It's just a way of hedging a portfolio. So some are going to be hedging, some are going to be just outright, they're bearish on the market. They think VIX is going to spike and do that sort of thing, right? Got to kind of look at it from a few different perspectives.
But then here's my point about being contrarian. The one thing that you're not seeing set up in the options market is a melt up. In other words, and one of the reasons that the VIX, you're saying is the reason the VIX is where it is now is because it's all in call volume. There's no put volume whatsoever, which makes me think, if nobody's betting on a melt up, that might be more likely. I'm not sure they get paid off for buying all the calls.
Yeah, look, I've been traveling these past few weeks. I've seen investors in Europe and the US and Canada, and I have to tell you, it's just consensus bearishness out there. It's pretty consensus.
She's traveling all over the world. It's consensus bearishness out there. Doesn't surprise me, I've watched a lot of CNBC the last 6 to 9 months, and yeah, it doesn't surprise me.
That does always make me kind of ask the question, what's the scenario that nobody is pricing? I can tell you definitively, the options pricing is not pricing any sort of up crash scenario, like you say. So look, if we do get some sort of miraculous congressional kind of detente and things go smoothly and it actually gets resolved much earlier than people expect, the market's not positioned that way at all. You're right.
Yeah,
100%. There's just a lot of investors are way off sides right now, and it shouldn't surprise you if you've been watching my reaction channel for the last year or so. I don't know if I've even been doing this channel a year, but how many times do I react to these CNBC videos, Bloomberg videos, and we hear bearish person after bearish person after bearish person, right? Give all these points for the last many, many months. These folks are not new bears. They've been bearish, like all of 2022, all of this year, and they continue to be cautious, pessimistic, right? Reluctant in the market. They use all these different terms. And at the end of the day, they're just so far off sides if we get an upside scenario. And a lot of people, it's kind of started, but a lot of people haven't recognized it yet, or they want to just kind of be dismissive of it. Nvidia's up 100%, but that's just AI. And it's just Meta's up 92%, but it's just, there's always a reason for why it shouldn't have happened, or well, that's just one stock. And then you go through these stocks and you're like, dang, this stock's already moved 20%. This stock's already moved 30%, 40%, 50%, 60%, 70% from where they were in the fourth quarter of 2022. And the more you start to get more and more of those stocks, the more you start to say, dang, man, maybe something else is going on here, right? Let's say we have a scenario where the consumer gets in a better spot actually over the next 12 months than they've been over the past 12 months because inflation continues to cool, real wages stay healthy, and unemployment stays under 4%, right? And earnings start to strengthen the back half of this year, which I think is going to happen, especially from the biggest big dog companies out there. Do you know the upside potential there? Do you know how much money's off sides in treasury savings accounts just chilling on the sideline right now that's going to have to flood back into the market in the back half of the year and going into 2024 at that point in time? Everybody's so caught up into the downside scenario, and it gets talked about time and time again. And I'm like, there's another scenario that could play out here, right? And it's just people haven't even considered this other upside scenario and how offside people are. And it's you think paying $238 is a lot for Meta. Wait till you're paying $438 for Meta. You think paying $110 is expensive for Amazon? Wait till in 2 years from now when you're paying, $225 for Amazon. So, you think paying $9 is expensive for Palantir? Wait till you pay $19 in a year or two for Palantir. So, I think these are just scenarios that people haven't even gone through yet. And I'm just let's just consider the other potentials here. I think it's important to always have both sides of the perspective.
On the flip side, and I have given, if anyone was watching in D.C., it's early. I know those people, I don't know if they get up. But I've given the president, he could do it. I think he'd look good at this point if he got together and did a deal, because he was always known as a deal maker. And sometimes I think he's listening to the wrong people at this time. But the other thing that you said, though, is that sometimes these people down there need a sell-off in the equities markets to finally get off get out of their chair and do something.
Yeah, it's interesting because there's sort of this kind of metacognition going on, if you will, a little bit kind of tail that wags the dog. I think Congress is very aware that the equity markets can be a tool. So, maybe you need the drawdown first before you get the action. This is one of those interesting things where, we speak to investors about the debt ceiling, and I don't think anybody truly thinks there's going to be a default, no. But they also don't think that they can look through this. They have to get through this, and getting through this in some ways means we have to get to a higher equity volatility level. So I do think that's why when you think about all the positioning in the market right now, the most positioning is coming in these VIX call options and the super high open interest through the summer months.
We've had a lot of politicians actually talk about what it would look like in terms of an equity drawdown that you said. So they've been threatening that could happen. So that makes me think that they know what they're doing as well. But there's no reason. It's so stupid. There's no reason to get to that point. We know we're going to pay our bills eventually, and we can. That's why we are the reserve currency of the world, is because we always do. So we know we will. So once again, this is some crazy. They're like children, and the rest of the country looks at what's happening and just wonders who elected these people, and they did. Anyway, Amy, I'm not asking you. You don't need to comment on that, but thank you. And
so in regards to this whole debt ceiling thing, man, this is politics. Welcome to the political landscape. Okay, this is politics. I guarantee you, there's talks going on from both sides right now, okay? I guarantee you they're working out details and all that crap. But in terms of what is going to be portrayed out there to the media, to big media and stuff like that, both sides have to look good. So you got, the House Speaker, what's his name, McCarthy or whatever, right? He's going to say, Biden doesn't want to do this, and, I've been trying to do this, and he's not taking this realistic. He's got to give a good, obviously, image and perspective for his side, and that he's fighting for his side and the other side sucks, right? Biden's got to do the same thing. All these guys are on all this unrealistic stuff, and they're not serious about this, and when they're serious, that's when I'll talk. They're both playing that game. This is politics, okay? This has been the way this has been for a long time. It's going to be the way it is going to continue to be. Both sides want to make the other side look bad. They both want to make each other look evil, and that they're doing their side a great duty. Meanwhile, there's discussions going on underground of what they're actually doing here, okay? Then, last moment all the time, all of a sudden it's like, we figured it out. That's the game, man. This is politics, okay? And that's why I don't even try to get in that game. It's a whole different world. And once you realize the world that is, you start to become less and less interested in that world. I'll just put it that way, okay? Next one up here, Paul Tudor Jones on where he thinks stocks are going, why he thinks stocks are going there, and all that little fun stuff up here. Let's get into this.
This Austin Goolsbee interview and some of his comments. I'm curious where you think interest rates will go, should be. What do you think?
I think they've done hiking. I'm so glad I don't have his job, because listening to these guys try to not say what they really want to say and what they really think.
What do you think he really wants to say?
He wants to say we're done, we've gone too far, and enough's enough. That's what he wants to say.
I agree. That is what he wants to say, and I agree that the Fed is done, 100%. And I've talked about that, obviously. I think I talked about that on yesterday's reaction video here on the Reaction channel. And I also spoke about that subject. Was that in the private group today? No. I spoke about that actually on the main channel today, why the Fed is done, and showing you kind of the numbers and the data behind that.
Say that because he's new on the board and he has to follow the chairman. But that's what he wants to say.
And what do you want to say? If you
I think he's right. I think they're done.
You think they are done?
Definitely, I think they're done. I mean, they could probably declare victory now, because if you look at CPI, it's been declining 12 straight months. 12 straight months. That's never happened before in history. So there's a strong downward arc to inflation at the moment. 2-year break-evens are under 2%. Clearly, they have to be governed by trailing 12-month inflation. But if we get to the here and now, you can see that inflation, to a great extent, has been wrung out of the market. Now, does that mean that we're getting ready to imminently cut? No. But you got to think of interest rates a bit like chemo. So chemotherapy, chemo is poison. Interest rates, with the kind of amount of sector-wide debt that we have between private consumer and the government, we're probably at levels where we've typically hit a recession in the past because of the interest tax on the economy. So we're at a level that historically has really slowed the economy and historically has kicked off a recession. I think it's just a question of waiting for that tax on the economy to work its way through.
Mistake, then, for them to raise interest rates?
Would have been a jump ball for me. I would have been 50-50 on the last one. I could have been talked out of it. I would have been reluctant to do it. The only reason why I probably would maybe have gone along with it is because I think equity prices are going to get, I think they're going to continue to go up this year, and the financial cycle drives so much of the business cycle.
Okay. So, but let me just pick up on what you just said. You just said you think equity prices are going to go up this year.
Oh, yeah.
So you think they're going to end higher than where we are right now?
Oh, yeah.
Oh, yeah. He says, oh, yeah, that's a confident, oh, yeah. Interesting, and I can see a way how you get there. Especially the fact that you're going to see a lot of the biggest companies out there, you're going to see their earnings get better and better, their net income, their EPSs get substantially better. And I think a lot of these analyst numbers are too low in relation to a lot of these companies. And plus, underneath the surface from there, you could look at the Russell's been an underperformer since basically Rona. I think that one's going to play a lot of catch up, especially if we have stability with the regional banking sector, KRE and that whole mess, right? And so you look out there and it's like there's definitely, there's downside risk, no doubt. But a lot of the upside risk just hasn't even taken into account. And I think that's one of the main factors I want to speak about in this video, okay? I appreciate y'all joining me as always. Thanks for being subscribed. Make sure you get in the 5-figure Hall of Fame. Check out pinned comment down there. Join us in the Patreon. You get to see the moves I'm making out there each and every week. And you also in the Patreon portfolio, and you also get access to the Discord chat. So I'll be pinned comment down there. And then if you want the 6-figure workshop, send me a DM on Instagram. Let me know you're interested in that. If you make over $100,000 a year, and I can send that over to you. Much love as always, and have a great day.